Ind AS 109 Financial Instruments Comprehensive Illustrations. Illustration 1. A Limited issued redeemable preference shares to a holding company Z Limited. Account for this in the books of Z Limited. It is financial asset to Z Limited. Repayment after 5 years. Date of allotment 1st April 20x1. Date of repayment 31st March 20x6. Value rupees 10 crore. Dividend no impact. Market rate 12% per annum. Present value factor at end of year 5 is given. Solution. Ind AS 109 financial asset recorded at fair value upon initial recognition. A Limited issued preference shares to holding company Z Limited. Relationship indicates difference in transaction price and fair value is investment made by Z Limited in its subsidiary. Market rate 12%. Present value at end of year 5 is 0.56743. Present value PV factor at end of year 5 into 10 crore, which gives the present value of loan component. 10 crore minus present value of this loan component gives investment in subsidiary. This is the opening balance in amortization table. Here is the amortization table and this is the opening balance. Opening balance plus interest gives closing balance, repeated for all the 5 years. The closing balance is equal to 10 crore. In this question, it is opening balance plus 12% interest, market rate. Each year 5 times gives 10 crore. Journal entries at every reporting date. This is date of transaction. Investment equity portion 10 crore minus present value. Loan receivable, the present value component, which is the financial asset, to bank 10 crore. End of year 1. From amortization table, loan receivable, financial asset increases to interest income. Income is credited. The same entries are repeated for the rest of the years for end of year 1, year 2, year 3, year 4. Now coming to end of year 5. 2 journal entries, one for interest income and one for settlement entry. For interest income, it is loan receivable to interest income. For settlement of transaction, bank account debtor 10 crore received to loan receivable 10 crore. Illustration 2. A Limited issues 1 crore optionally convertible bonds on 1st April 20x1. Bonds life is 8 years, face value rupees 10 each. Interest payable at end of each financial year is 6% per annum. Each bond converted into one ordinary share in A Limited. 8% is the interest on debt issued by similar company, which is 8%. Required initial recognition, journal entries, interest expense over 8 years, and accounting entries if holders convert bonds to shares at end of 3rd year after receiving interest for 3rd year. Solution. Applying the guidance for compound instruments, present value of bond is discounted at 8% is the liability component. Difference between present value of bonds and issue price of 1 crore is the equity component. Present value of principal discounted at 8% gives this value. Present value of interest discounted at 8%, which is 1 crore into 6%, which is 6 lakhs, into present value annuity factor calculated as 1 divided by 1.088 times, and click GT once, gives this value multiplied with 6 lakhs. Total present value is present value of principal plus present value of interest component, which is this value. Equity component is 10 crore minus the present value of principal and interest. Accounting entries. Initial recognition. Bank account debtor 1 crore, amount received. To convertible bonds, liability, present value of principal plus interest. To convertible bonds, equity component, amount received minus present value of principal plus interest. End of year 1. Interest expense 8% of present value of principal plus interest. This is taken from amortization table. This is the amortization table, and this is the 8% interest. To bank, the actual amount that is paid. To convertible bonds liability, this is the balancing figure. Now coming to amortization table. It is closing balance. This is taken as, sorry, I'm repeating this again. Amortization table, the present value of principal and interest plus interest at 8% minus payment gives closing balance. The same is repeated for all the years, and these are converted into equity shares at end of year 3. If holders of the bonds elect to convert to ordinary shares at end of third year after receiving their interest payments. At end of year 3, interest expense. Year 3, 8% interest column in amortization table. To bank, actual interest paid. To convertible bonds, balancing figure. On 31st March 20x4, on the same date, conversion entry. Convertible bonds liability is derecognized. This value is taken from amortization table, closing balance at year 3. Here it is. Convertible bonds equity component is 1 crore minus present value of principal plus interest. To ordinary share capital 1 crore and securities premium balancing figure. Illustration 3. On 1st January 20x1, SAM Company Limited agreed to purchase $20,000 from JT Bank in future on 31st December 20x1 for Rs 68 per USD and not pay any on this date, on the date of transaction. SAM Company Limited prepares quarterly financial statement basis. Record entries for each quarter ended till actual purchase of USD. Mark to market fair value of forward contracts. At the end of Q1, it is minus, at the end of Q1, which is 31st March 20x1, it is minus 25,000. For 30th June, it is minus 15,000. 30th September is 12,000 positive, and spot on 31st December is rupees 66 per USD. Solution. Assessment of arrangement. Characteristics of derivative financial instrument. Its value changes in response to change the change in a specified interest rate. In case of non-financial variable, it is not specific to a party to the contract. Requires no initial investment or smaller than other types of contract settled at a future date. Upon evaluation of contract meets definition of derivative. Value of contract to purchase USD at a fixed price changes in response to changes in foreign exchange rate. Initial amount paid is 0. Contract is settled in future. Derivative is a forward exchange contract. As per Ind AS 109, derivatives measured at fair value upon initial recognition, subsequently measured at fair value through P&L. Accounting on 1st January 20x1. Fair value on date of inception is 0, no entry. At end of Q1, profit and loss of 25,000 to derivative financial liability 25,000. At 30th June 20x1 Q2. At end of quarter 1, it is minus 25,000. At end of quarter 2, it is minus 15,000, which means derivative financial liability has been reduced by 10,000, which is profit. DFL account debtor, derivative financial liability 10,000 to profit and loss, reduction in liability, which is profit, gain is 10,000. Accounting on 30th September, end of Q3. At end of Q3, it is 12,000 positive, which means 15,000 of DFL has been reduced and Derivative financial asset is increased by 12,000. Derivative financial liability account debtor 15,000. Derivative financial asset 12,000. Profit and loss account 15 plus 12 27,000. Accounting on 31st December 20x1. Settlement date end of Q4. To bank $20,000 into 68, which is the agreed price 13 lakh 60. To derivative financial asset, DFA balance utilized. DFL balance, derivative financial liability is nil, which was already reversed. Bank account at 20,000 into 66, this is the spot rate 13 lakh 20. Profit and loss account, this is the balancing figure. Illustration 4. Entity A having rupees as functional currency enters into USD 10 lakh sale with entity B. Rupees is the functional currency for entity B also. To sell equipment on 30th June 20x1. Embedded derivative, entity A and B same functional currency, which is rupees, but entered into contract to sell dollars. Separate the contract into sale of equipment contract and contract to hedge the risk, which is the opposite position is taken. Purchase of 6 months forward $10 lakh into rupees 55. Solution. On delivery, entity A records sales, which is rupees 55 million. Embedded derivative is considered to expire. Derivative asset or liability settled by becoming part of financial asset on delivery. Which is calculated as 10 lakhs into 60 minus 55, which is 50 lakhs gain. 55 minus 60 minus 55. The table summarizing the computation of gain or loss to be recorded at every period end. 1120x1, we take 6 months forward at rupees 55, and on 31st March 20x1, which is the reporting date, 3 months forward is 45 rupees. The loss is 55 minus 45 into 10 lakhs gives rupees 1 crore DFL loss. On 1st January, embedded derivative nil value. On 31st March, which is the reporting date, change in fair value. This 55 minus 45, which gives 1 crore loss in DFL, 1 crore loss PNL. On 30th June 20x1, change in fair value of embedded derivatives, which is 60 minus 45, which gives 1.5 crore DFA, derivative financial asset. On 30th June 20x1, recording sale at forward rate, which is $10 lakh into rupees 55, which gives 5.5 crore. Debtors account debtor to sales account. Embedded derivative settled against debtors, which is 1.5 crore of DFA minus 1 crore of DFL, which gives 50 lakhs. Here DFA account debtor to PNL account, but since it was given in the question, this DFA or DFL, the net amount is settled by becoming part of financial asset on delivery. Hence this DFA becomes debtor account debtor to DFA account. Hence 5 lakh has been transferred to debtors account and reduced from DFA account. Journal entries to be recorded at every period. Initially, no journal entry on date of transaction. At 31st March 20x1, PNL to DFL, which is 1 crore. On 30th June, derivative financial asset 5 crore, derivative financial liability, this is 50 lakhs and this is 1 crore, to PNL account 1.5 crore. 30th June 20x1, trade receivables 5.5 crore to sales 5.5 crore. On 30th June 20x1, trade receivables account is 50 lakhs to derivative financial asset 50 lakhs. Illustration 5. On 1st January 20x1, SAM Company Limited entered into a Britain put option at of $20,000 with JT Corporation to settle on 31st December 20x1 at 68 per USD. Not receive any amount upon entering into contract. Record entries for each quarter till actual purchase. 31st March 20x1 is 25,000 loss. On 31st June 20x1, 15,000 loss. On 30th September nil. Spot rate on 31st December 20x1 is rupees 66 per USD. Assessment of arrangement. Characteristics of derivative. Its value changes in response to change in a specified interest rate. In case of non-financial variable, that the variable is not specific to a party to the contract. It requires no initial investment. Settled at a future date. Contract meets the definition of derivative. Value of the contract to purchase USD at fixed price changes in response to changes in foreign exchange rate. Initial amount received is nil. Contract is settled in future. Derivative liability is a written put option contract as per Ind AS 109, measured at fair value upon initial recognition, subsequently measured at FVTPL. On 1st January 20x1, no entry. On 31st March 20x1, P&L account data 25,000 to derivative financial liability 25,000. On 30th June 20x2, Q1 it is minus 25, Q2 it is minus 15,000. The difference is reduction of 10,000 in DFL, which means profit. Derivative financial liability 10,000 to P&L account 10,000. 30th September 20x1. Q1 minus 25, Q2 minus 50. The difference is reduction of 10,000, which we have seen in Q2. Now coming to Q3, it is 0. The balance is nil. So 15,000 of DFL has been reduced. Derivative financial liability to P&L account 15,000, 15,000. On 31st December 20x1, the settlement date. To bank 20,000 into 68, the contract rate. Bank account data 20,000 into 66. This is the spot rate. The balance. Sorry, please ignore the alarm sounds. Bank account data, P&L account data to bank account. Illustration 6. ABC company issued 10,000 compulsory cumulative convertible preference shares on 1st April 20x1 at rupees 150 each. Dividend 10%, convertible into 5,000 equity shares at end of 5th year. Market rate 15%. Transaction cost is 2%. Look out for EIR in question. If not, we have to calculate EIR. Allotment date 1st April 20x1. Conversion date 1st April 20x6. Number of preference shares 10,000. Face value 150. Total proceeds 15 lakhs. Transaction cost 15 lakhs into 2% is 30,000. Face value of equity share is rupees 10. Effective interest rate EIR is 15.86 given in question. Compute liability and equity component past journal entries for entire term. Solution. Computation of liability and equity component. We calculate it as present value of dividend discounted at 15% for 5 years, which gives the liability component. Before using this amount as opening balance of amortization table adjusted with transaction cost. The liability component is calculated as dividend 1,50,000 discounted at 15% of market rate each year. The total is taken as this. Equity component is 15 lakhs minus the present value of liability component, which gives this value. Allocation of transaction cost in the ratio of liability and equity. Ratio of liability and equity is these two values. Allocated amount, which is taken as 30,000 divided by 15 lakhs into 502,823. This is also calculated similarly. The net amount, this amount minus allocated amount gives net amount. Amortization table. This is the present value of liability on initial recognition. Add interest at EIR 15.86% minus cash flow, that is the dividend paid is 1,50,000, which gives closing financial liability. The same process repeated for all the years. Journal entries. Initial recognition. Bank account debtor 14 lakh 70, which is the net amount 15 lakhs minus 30,000. To preference shares liability. To equity component of preference shares account. These two are the net amount after allocation of transaction cost from this table. End of year 1. Preference shares liability account debtor to bank account, actual amount that was paid. On the same date, finance cost account debtor at EIR is taken to preference shares liability, EIR taken from amortization table. End of year 2, similar journal entry till end of year 5. This is taken from amortization table, the interest finance cost. Now on conversion to equity shares, liability component is already exhausted. Hence on settlement date, equity component of preference shares. This value is the net balance of equity component that we calculated. To equity share capital 5,000 into rupees 10, 50,000. To securities premium, it is the balancing figure. End of comprehensive illustrations. Thank you.